Hello everyone, and thank you for tuning in to our Gamma Scalping tutorial where you can learn to build an options trading strategy using Alpaca's trading API. My name is Tony Lee, President of Alpaca Securities and Product Strategy. First, a huge shout out to our amazing community. Your requests and ongoing support for these options tutorials mean a lot to us. We are thrilled to let you know we plan to produce even more in the coming months, so please stay tuned. And if you have specific strategies or theories you'd like us to cover, you can drop your ideas in the comments below. We'd love to hear from you. And if you find this video helpful, give it a thumbs up. It helps other algo traders discover our content while also supporting our channel. Before we dive in, a quick note on what Gamma Scalping is. So this strategy aims to capitalize on higher levels of market volatility compared to what's currently priced in. It works by maintaining a delta neutral position and rebalancing as the delta changes due to market movements. Hence the name Gamma Scalping, which refers to the option Greek gamma, which measures the rate of change of an option's delta relative to the stock price. If you want a refresher on how to use Alpaca's API for options trading, be sure to check out our previous video for a detailed overview. Now let's get into it and start deploying our strategy using Alpaca's trading API. Okay, so let's get started. I've already imported all the libraries required and the Alpaca API is required for this demo. So now I am applying Nest Asyncio so that we can run asynchronous code in Jupyter Notebooks. Next, I'm setting up our API keys and enabling paper trading so that we can run this in a paper trading environment. I always recommend not hard coding API keys into your code as I've done. It's always better to use environmental variables or some sort of password manager. Next, we are setting up our Alpaca trading clients. One of them will be used to execute orders. The next is used to subscribe to our streaming endpoint so that we can get updates on orders and positions. The next one is to get underlying stock market data. And the last one will be to get option market data. Next, we are setting up our configuration variables. So the first one being which underlying symbol we'll be running on, which for our example, this will be JP Morgan. We'll also be setting our maximum absolute notional delta of 500, which means that our code rebalances our delta as soon as our notional exposure gets to the over or under $500. We are also assuming a flat risk-free rate of 4.5%, which may or may not be applicable for this. And also, it's always better to use a risk-free curve in live examples. Next, we're going to be getting all of our existing positions using the trading client, and we will be running through all the positions and liquidating any positions related to JP Morgan. So this may actually be positions in JP Morgan stock itself or any options related to JP Morgan. And so if we encounter any of these positions, we will be sending an order to actually close the position using the trading client. Now we'll be adding JP Morgan into our position JSON, which will be used to keep track of all of our positions. So now we will be setting it with a position of 0 since we assume we have liquidated all of our positions and also an initial position of 0. For the purposes of this demo, we will be picking the first 3 call options that are between 14 to 60 days in maturity that are at least 1% above the current spot price. So at least 1% out of the money. So in order to do this, we will need to get the underlying stock price of JP Morgan. And we will be creating a function that will use the API endpoints to get the stock price. And we will be setting a min strike of price times 101. So now we will be using the get option contract endpoint to get the option chain where we will be filtering for options that meet the criteria that we had just specified. So now we will be getting the first 3 options returned in the option chain and adding them to our position list with a position of 0, since we are assuming that we do not have an existing position on JP Morgan options, and also with an initial position of 1, which we'll be utilizing later in our code. Now we are going to define our functions, which will calculate implied volatility and Greeks using Black-Scholes. One thing to note is that these functions use Black-Scholes, which assumes European options. We have done this for simplicity just as a basic example of how to use our Alpaca API for algorithmic trading. So for those of you that are familiar with Black-Scholes and options trading, you'll know that there's some limitations of using this strategy for American options, particularly if it's a very short-dated option or a dividend-paying underlying. So the first function is where we calculate implied volatility using the Brent Q function. And now we are setting up our basic Black-Scholes option pricer to calculate Greeks, which we'll be using later in the code as we calculate our live delta positions. So now we are setting up our trade update coroutine. So this coroutine runs every single time the streaming endpoint returns a trade update. First, we check to ensure that the symbol is on our position list. And if it is, and also it is either a fill or a partial fill event, it will update the position that we have recorded in our position JSON. So now we are subscribing that coroutine to the trade update stream. Now we're setting up our coroutine that will execute our initial trades, which will run in our main loop. So first it waits 5 seconds and then it will iterate through our position list and look for any positions where the initial position is 0. As you saw earlier in our code, the 3 options that we had selected to be in our demo, we had set an initial position of 1. So when this coroutine runs, it will look to buy 1 option contract. So now we are creating a function called maintain delta neutral, which will run periodically to rebalance our delta. So what it does, it iterates through all of our positions and calculates live delta positions based on the current underlying spot price and the current price of the options. As it iterates through the positions, it'll take the position we have in JP Morgan and add it to our current delta. And it'll iterate through each of the often positions and calculate the live delta using the Black-Scholes functions we created earlier and adding those to our current delta. At the end now, we run the function that adjusts our delta to maintain a delta neutral position, which we define here. So now with this function, we check to see if our current delta is above or below our maximum notional delta, which we had set earlier to be $500. So if our delta is above or below $500, it will execute an equity trade to rebalance our position back to a delta of 0. Now we are setting up our coroutine gamma scalp, which will run our delta neutral function initially after 30 seconds, but then afterwards it'll run every 2 minutes. And these are default settings which can be overridden. And now we will be running our main event, which will loop indefinitely until we exit out of the code. So first we run the initial trade coroutine, which will run after 5 seconds. And then also at the same time runs the gamma scalp coroutine, which initially runs after 30 seconds and then every 2 minutes afterwards. Now that you understand how to set up a gamma scalping strategy, the next step is testing it out. So we always recommend starting with paper trading or back testing to refine your parameters and see how the strategy performs across different market conditions. This is a crucial step to ensure you're prepared for live trading. If you're enjoying these tutorials and finding them helpful, don't forget to subscribe to our channel and enable notifications so you don't miss any future strategy guides. We've also got a dedicated playlist packed with more videos like this one, so be sure to check that out to expand your knowledge even further. Lastly, remember to review the important disclosures linked in the description below before you begin trading. It's essential to understand the risks associated with options and algorithmic trading. Thank you for watching, and we'll see you in the next video.